a few years ago, we ran an online, multi-day innovation seminar in the middle of COVID. And you're one of our superstar speakers then, and it was one of the pleasures of basically a version of what you're going to talk about today. It was one of the highlights for me of that 3 or 4 day intensive online thing that we did. So very excited. So we're back. So yes, hello everybody. I'm Steve. We run the WA Innovation Calendar, so I hope you all enjoy that. We'd love to hear from you as well on on things that we can do better for you for the WA Innovation Calendar. And as you've all seen in the last 6, 12, 24 months, WA Innovation has really, particularly the events and the programs that have been going around, have really spiked. So there's a lot of stuff going on. So we hope you're all enjoying as many innovation things that the WA ecosystem puts together for you, and we're always happy to see if we can improve it and increase the content and the quality. So always open, never hesitate to reach out. So today, absolute pleasure, as I said, to have Mike here. And one of the reasons that we have superstars like Mike that we bring to you, and one of the reasons, not one, the reason that we run the WA Innovation Calendar, is because for 20 odd years that we see fantastic programs, events, people, networks and things, but if you don't know where they are or who they are, you're going to miss out. And your chance of innovation success, of taking your innovation from wherever you are now, whatever sort of innovation you're doing, from here to the next step, is greatly diminished if you don't know who's out there and how to get that help and those sorts of things. So that's why we did the WA Innovation Calendar to start with, to share the community's knowledge. And basically because, really quickly, there's 5 things that makes an innovation journey successful. We're talking about the journey you go on. So what are those steps that you take as an innovator to get from day 1 to day X? That's pretty much a well-trodden path. We've heard of Valley of Death and those sorts of things. Those are pretty standard steps. It's going to tweak and differ a little bit for everybody, but the steps are pretty much the same. So we go, okay, if you know what the journey looks like, you're going to have more chance of success. If you know what each step involves and also what to prioritize and how to diagnose where you are and where to go next, we see that as a massive difference. So our clients that either have done it before or have learned from somebody else, to go, oh, if I'm here, what are these millions of things as an innovator I should do? Prioritize down to the most critical ones. It'll kick you along. So what's the journey? What's the next step? Where's the money? Who's got the money? How do you get the money? And those sorts of things. Critical. Different money means different things to different people. That's why we've got Mike on today. It's one of the pillars of the, if you like, your successful innovation journey. And Mike knows it more than just about anybody in WA, that's for sure. So we've got the pillars of the funding. Then you've got the experts. Who are the experts you're using? You can't do it all yourself. So what experts are you using, when you're using, how are you getting access to them? Again, that's part of the calendar. And then finally, who are your peers? Who are you hanging out with? Who are you sharing your knowledge and doing those sorts of things with? So what networks and integrations are you having to help? And again, that's one of the reasons you're in the calendar, so you can see all these things going on. So there's the five points. Mike's a critical part of all of those, well, particularly the funding one. This session today goes for about an hour. So it's content that we could spend, and you know, I had a practice with Mike the other day, and I kept pausing him and talking about too many things of interest. So I will have some input, but I'll hold myself back. I won't ask too many questions. And that's my dog wants to ask the questions as well. You're probably hearing. So we've got a lot of time. We'll do some questions at the end. If we have some time for Q&A, we'll open up at the end. So if you can, I'd ask you to hold your questions back. Put them in the Q&A section in the drop down, in the dots down the bottom there, and we'll keep a track of them if we can. If we don't get to it, then you will get Mike's contact details, and so he's very generously shares his time to answer those questions as well. So if you want to email him directly, you've got access to him. Housekeeping. Video on. I think we're recording here somewhere. So this is being recorded. So yep, it's be shared. So Mike and I will have to maintain, or I'll have to maintain my lack of swear words and be a good boy. So we'll keep an eye on the language. So yeah, we'll record it. We'll get to the end. Now, the presentation is effectively split into 2 parts. If you do have to drop off at any stage, completely get it. We have other things going on. Apologies for that. But I do recommend that if you do have to drop off, you come back to the recording, because the second half of the presentation is the rubber hitting the road. So we've got the background and the if you like, the valuations and the funding landscape and those sorts of topics. But then, which is great. But what's even more important is now, how do we contextualize that, and how do you actually fund? How do you raise money? What do you do? And that's where pitchhawk comes in. And so you're really going to, if you don't get that, you're going to miss out on the, if you like, the implementation. And we see that a lot with innovation. We see a lot with everything. We can learn all these great things, but we don't have an action. What's that call to action? What's our next step? What are we going to do? And then we drift along. So please, either stay till the end, or preferably stay till the end, or then come back and watch the video we'll be sharing with you afterwards, because that's the action step that you need to listen to. So let's get started, if that's okay with everybody. I'll get out of your way. But basically, very quick intro to Mike. Mike's got, I don't know how many years, we'll call it, we'll round it to 30. We'll round it to 30 years of experience.
Knock a few off, Steve.
Okay.
Off.
Yeah, we wish we could knock a few off. Yeah. So we'll call it the best part of 2 or 3 decades of basically funding experience, capital markets experience. When you're looking at, if anyone done the 10,000, learned about the 10,000 hours rule. So once you've done 10,000 hours, you're a legitimate expert. Well, Mike's cracked the 10,000 hours by some. So one of the critical people has been in WA. Helping companies fund in a different way, raised and be involved in transactions up to $10 billion in total across all of his journey. And a lot of those are innovation based. And so again, the beautiful thing about Mike and Mike's experience, it's cross industry, but deep innovation. And so it's not somebody, Mike, I'm not going to bring you somebody in here that's going to tell you, how to do, if you like, a listing process. If that person's only ever done exploration listing, Mike's got experience across the funding landscape, but with innovation depth as well. So I'm going to get out of the way. Mike, thank you so much for joining us. Please kick it off, and I'll try not to ask too many questions as we go.
Cool. Thanks, Steve, and obviously great to be here. Thanks for inviting me back. And yeah, we did have a lot of fun the last time, so hopefully we can do that again today. And today we're really going to try and give founders and the innovation community some hacks, 4 or 5 hacks that can make your life a lot easier, so you can recognize what's going on around you while you're building. And from in support of that, what we're going to talk about is, first of all, what's driving valuations? And if we can pinpoint what's actually driving it, can we use that as a lead indicator so that you can time your fundraising program and potentially shape it as well? Secondly, because everyone talks about AI, we have to address AI. It's a bit of a valuation distortion at the moment. So after we speak about valuations, we'll speak about how AI has distorted it and what that means. Does it mean that we're in a bubble, or part of AI might be in a bubble and other parts might not? So we'll just spend a few minutes on that. Then in from angels to sovereigns, we'll map out what the current innovation landscape looks like and where we think money is going to flow for the rest of this year and into 2026. And finally, we'll talk about the launch of Pitchhawk. It's an investor readiness platform that I spun out of Next Level Corporate in July this year. So the hawk is still very young. It's flown out of the nest and developing some really nice traction. We've had a few people through, so that's been going well. But the idea is, what do you really need to do before you step into the markets that we're going to talk about today? And how do you really get investor ready as opposed to summary ready or advisor ready? And there's a big difference between them. So without further ado, let's dig in. I know I've hit you with a chart straight away, but just think about it as a cartoon and put it to the side for the moment, because this is hack number 1. And firstly, before we look at the chart, it's important that you understand that your specific tech, your solution, your company doesn't drive your valuation. What really drives valuations is liquidity. And that's across all asset classes. That's across fixed income, it's across equities, it's across crypto, etc. Effectively, more money and liquidity in the system pushes multiples up. Less money in the system pushes them down. That is the relationship. And we'll come to it, but there's a 77% correlation between the two of them. It's a negative inverse correlation. And it's because interest rates drive liquidity conditions that they are our lead indicator. So all the way through these couple of slides, focus on interest rates and the 10-year yield in particular, because the 10-year yield is the risk-free rate. More importantly, if we can actually predict where valuations are going to go using interest rates, they become a lead indicator. They can help us potentially time when we should be running into tapping markets and perhaps when we might be wanting to sit on the sidelines. So this is how it works. Low interest rates means more liquidity, more money flows into markets. The lower the interest rate means that the company cash flows, when you discount them by the low interest rate, look more valuable. Obviously, when interest rates go up, you're discounting your company cash flows at a higher interest rate. That means the present value of those cash flows or the value of your company is going to be lower. That's what actually happens in markets. So let's now have a quick look at the chart. We start here just before COVID. What I should probably do is just define it first. This orange line is the 10-year Treasury yield. It's the risk-free rate. It's basically the global risk-free rate, and it's used in the cost of capital calculation. The blue line is the Bessemer-McLeod index, so that tracks about just under 70 of the fastest growing cloud companies on NASDAQ. And you can plainly see it. As interest rates come down, valuation multiples go up. As interest rates come up, valuation multiples go down. And there's a 73% negative correlation there. I'll explain this little blue hump a little bit later, but that's really the only time where we break the relationship. But just quickly starting here before COVID, we were trading, or SAS was trading at the 9-year average of 8.7 times sales. Then COVID came along and trillions of dollars went into markets. And what I mean by that is zero interest rate policies were instituted by central banks. Trillions of monetary and fiscal stimulus were injected into markets. Liquidity went through the roof, hence the trillions down here. What then happened is it forced interest rates down, and that was reflected in the 10-year yield, which dropped to 0.55%, which is an all-time low. On the other hand, 6 to 9 months later, we see multiples up at 16 times sales, and the real hot names were up around here. They're off the chart. They're like 25 to 30 times. But then in anticipation of inflation, which finally turned up right here in 2022, yields started coming up because bond market expected that the Fed was going to raise rates. So rates started coming up. Valuation multiples came down. And then we had quantitative tightening, which meant that the central bank started to pull liquidity out of the market. So again, liquidity comes in, valuations go up. Liquidity comes out, valuations came down. They created down at 4.2. Now we've finally got to 2024 and central banks decided to increase, cut interest rates. And we're starting to see interest rates start to roll over and valuations start to come down. If we go into the next slide, we'll just get rid of all the noise and just focus on this last bit. Why did that relationship break down? And it was quite simple. The Treasury, so not the Federal Reserve, not the central bank, but the Treasury took $800 billion out of the Treasury General account and injected that into the economy. That found its way into markets and it pushed multiples back up for a short period of time. That went on for 12 months. After that, and since then, liquidity's been pretty neutral, slightly negative at about 35 billion that's come out. So if that hadn't happened, I've drawn this little grey line and I've replaced that spike with a trend estimate. That trend estimate increases the correlation or the negative correlation to 77% up here. And the R2, or the coefficient of determination, which tells us how much of valuation do interest rates explain, sits at 60%. Now, I think that's a pretty good lead indicator for valuations. If interest rates can explain, certainly they represent liquidity, but if they can explain 60% of valuation moves, I think there's something that you want to track. The final thing I'd say is that there's a 6 to 9 month lag. So if you believe the analysis, interest rates explain liquidity, or 60% of valuations, and there's a 6 to 9 month lag. It means that if we do enter a real or a genuine rate cutting cycle this year, and next Tuesday we'll find out if the Fed is going to cut by 25 or 50, it may pause, but I think it'll probably cut, but don't quote me on that. And this is certainly not investment advice. But if they do, and there's a couple of cuts this year, Australia's probably going to lag a bit, but it doesn't matter. America is the biggest market. NASDAQ is 10 times the size of ASX, and this is where all the money's flown. So what you need to look at is the 10-year Treasury yield in the US. If that starts to roll over, then 6 to 9 months, if you count forward, we're probably looking at April to June next year when valuation multiples are going to be coming back up. And why does that matter? Because as a founder, you're not going to go out there and raise money at 4 times unless you're forced to do it. You're going to look for non-dilutive methods, or you're going to try and store your fundraising and grow based on cash flow. So it's a pretty important item to think about. And to the extent that we do have a nice valuation runway next year, multiples go up, founders are reasonably happy with that, interest rates will be down. So what that means is that investors are going to discount the forward cash flows to a much bigger number in present day value, meaning they're going to be happy to pay higher amounts. All of that together pushes up valuations. So that probably finishes this section. And Steve, if you wanted to.
Yeah, thank you, mate. And again, great summary. And I think for the majority of us that work, if you like, on the the founders, the startups, that need to raise the money, I don't think I've any of them in my 20 plus years of experience have framed it that well, that clearly, or the advisors that that I've sort of got the feedback from. That yes, in summary, it's like, I guess what you're saying is, you can pitch. Obviously, if you have to go and raise money, you have to go raise money, people. That's rule number one. But if you know the backdrop, not just the but how if you like, the funders are investors are placing that money in the consideration of the macro, not just that deal. So it doesn't matter how good your deal is, no matter how awesome your deal is. It's about the capital that's available and what return they want from that capital and the risks and everything else that's going on behind them. They're the ones with money. They're deciding where to put it. And if we put that lens on, it makes it a little much more comfortable to go, oh, okay, well, why is my valuation different to that guy's that's just had it 3 years ago? Yeah, well, it was 3 years ago. It was different, different market, different place. You can't compare your valuations for many reasons, particularly across years, obviously. And I think that's what Mike is suggesting is, if you're going to have to raise and the interest rate sort of correlation is the wrong potential wrong schedule, well, can we minimize our raise non-dilutively for a while and see if we can wait and raise as the markets sort of change, and then get a better valuation, obviously give away less equity or raise more for the same. Have I picked up what you put down there?
Yeah, 100%. It's exactly what I'm putting down, Steve. And I think one of the other relative valuations, relative returns in markets across entire asset classes, which is where you were going, absolutely dictates where money goes. And when we're talking about valuations and that SaaS multiple, which, by the way, is tracked by Bessemer Venture Partners, it's an awesome free resource, and they put out a whole raft of different indexes That particular one was the forward revenue multiple, and it's a median. And why I wanted to bring that up is that what we're talking here when we talk multiples is the median multiple or the swim lane. So your company is still very important, clearly. Your company-specific matters do help to define, but they define either within the swim lane or whether you trade at a premium or a discount. If you're a highly scalable business, super viable, growing like the clappers, and you've got a moat, you're probably going to trade at a premium to the swim lane. But if you're not, or if you might be a tech-enabled service, and we're in a market where VC is just throwing money into SaaS, enterprise, AI, etc. No one really wants to talk about tech-enabled services. You'll probably trade at a discount. So company-specific, I guess the waterfall is as follows: the overall macro, the 10-year yield, other flows in and out of markets. Then we come down to company-specific matters. And depending on how strong your business is, you're going to trade at some kind of premium or discount to that general level.
Yeah, that's cool, mate. And it doesn't matter. I think again, the summary is, can pitch as well and as hard and as awesome as you want. There are other factors going on behind that the investors not just listening to the pitch. It's like, yeah, cool, I love the pitch. I will invest, but this is the return I want, or this is the benefit I want out of this. Doesn't matter what the pitch looks like potentially at that stage. It's the market that comes is the first thought for the investor.
Exactly right. And I remember, stomping around after the GFC, or at the time of the GFC in Australia, our kind of mini GFC was when RAM home loans went down. And we were stomping through Sydney, about to go in to see an institutional investor. And I won't mention names. I do remember who it was. But we got phone calls from several investors, probably within the vicinity of 15 to 20 minutes, all going, don't turn up, don't come. And we did end up raising money on that one, but it was a very extremely tough process. So when you're in markets that are conducive to fundraising, you're just going to notice, and you may not realize it because you might not have looked at the macro. But if you look back and see some of your most successful fundraisings, you might find that the macro is really nicely tuned and very conducive to fundraising at the time. Of course, there's always exceptions, but that's what generally happens. When markets are conducive, investors are welcoming. They want to deploy capital. That's their job, generate returns and P&L. So, yeah, that's probably what I'd say on that one, Steve.
Thank you. Next.
Okay, so we've got to talk about AI, and I wanted to frame it a little bit differently because we've just seen how liquidity defines the overall swim lanes. The macro is important. Then there are some fiscal lags and various other things going on that explain the other 40% after the 60% that we spoke about could be explained by interest rates. But then there are other things that determine valuations. Sometimes we get a glitch in the matrix, and we've had quite a few of those. They aren't always timed with booms and busts or bubble bursts, but I thought it would be just worth having a look at some of these technologies that have gone through Cambrian moments and then track to see why they've distorted things. And probably the best way to do it is to look at the time it took for all of these technologies to get to 100 million users or their adoption curves. The telephone, which it really stunned me, but it did take 75 years. Clearly, it was introduced around the time of World War II, but it took 75 years to get to 100 million users. Less people around there, population was thinned out, and also access to a telephone was a lot more difficult. Access to funding was a lot more difficult. The mobile phone, again, intuitively, we all think it probably took less than 16 years, but it didn't. It actually took 16. And it wasn't until the old Motorola brick was replaced with a smartphone that it really started to accelerate, kind of like a PC in the pocket. Then we started to get really interesting. The internet kind of only took 7 years. Now that's really, that halved the curve. that halved the adoption curve of mobiles. And I was also a little bit surprised at that one, but the internet grew at a 40% compound annual growth rate. And that's pretty damn fast. And that includes the period of time that it straddled the .com bubble. We were going to talk a lot about .com and Look Smart and some of the, Australia's first unicorn. I was at Macquarie Bank at the time, and the Sydney desk floated Look Smart on NASDAQ. First Australian unicorn, $1 billion valuation back then, 1998, 99. Traded up to 5 billion really quickly, but then got absolutely smashed and barbecued with everything else. The 5 or 6 trillion in market cap blew up during the .com bubble. That was one of them. And it wasn't the only one. But nonetheless, the internet grew at 40% compound annual growth rate. Its problem was that the infrastructure was there, but the content wasn't. That was the problem back then. Then we moved to one of my favorites. I just want to get this pen going right. So crypto got to 100 million users in only 4 years. It's been growing at a 90% compound annual growth rate. Had the various regulators around the world decided to approach and address regulation earlier, I suspect that would be potentially double that growth rate. So crypto's grown very fast. I think its next tailwind is the convergence of AI with crypto. But onto AI, that's just gone parabolic. That hit 100 million users in 2 months, and that's ChatGPT specifically. It's now 700 million plus users. So the question is, as the USS Enterprise flies away, is this a bubble or not? And there are so many different opinions. So I thought we'd look at 3 different layers of AI, which is down the bottom here, to work out, okay, what's really hot, what's a bubble and what's not. And I think the software layer, not all of it, but part of the software layer, particularly generative AI and LLMs, are probably in a bubble. Those valuations are insane. They're really stretched. But C3.ai, I'm not singling them out. I could have used 3 or 4 different ones, just happened to be using that one. It's a generative AI hyperscaler, brand new business model, 389 million in sales, massive loss, still a 2.3 billion market cap. And in that case, the hype is outpacing the profit. We're still really waiting to see with a lot of these companies at the software level what their monetization is going to look like. So I would call that a software layer bubble. CoreWeave, which funnily enough has jumped on 2 adoption curves, it's an ex-crypto miner. It's now a GPU cloud provider. 1.2 billion, or call it 4.8 billion annualized revenue. Still making losses though, very strong growth. And 2/3 of its 30 billion backlog or future income is concentrated in 2 customers, OpenAI and Microsoft. It's not an auditor's dream, but maybe that one's not in a bubble. It is pick and shovel. Unfortunately, we still don't have any genuine price discovery with it, but I don't think that one is the same as C3 and the C3 cohort. I think, jury's out. But the Mag 7 is absolutely not in a bubble. It's been the biggest beneficiary so far of AI. And yes, they're all trading at somewhere between 20 to 30 times forward PE. So they are stretched, but they are backed by incredible growth rates. And in the last 12 months, or the last fiscal year, I should say, they were growing at 28% earnings growth versus around 9% earnings growth for the other 493 companies in the S&P 500. So I think they're well supported. I don't think AI in that bucket is in a bubble. So that's probably the key thing I want to talk about AI, Steve, if you wanted to flesh any of those things out.
So, no, awesome, mate. Thank you. And again, across our R&D tax client base, it seems like every second business is adding AI to its business to because they want to try it out or whatever. But plenty of people look like they're adding AI to get a valuation bump almost. But that was really, really important. So while there might be an underlying AI bubble at the moment, which is obviously, shouldn't normally be sustainable, within that, if you remove the bubble effect, there is still that, what is the business within this technology? So whether it's AI or whatever it is, the business itself, how are you moating? So what is your difference to everybody else? How are you protected? What is your income stream? How are you going? And so that is still if you like, the driving criteria between it's just tech versus I know we've got a substantially defendable, growable, scalable business here. It's still the driver for the premium multiple, if that's correct.
Exactly right. Yep.
Yeah. Cool. Thank
you. And it probably segues into the next bit where we thought we'd spend a little bit of time talking about where we think the money's going to go. It's worth mentioning at the outset that AI isn't in this chart here individually, because what we're finding is that it's embedded in just about all of these industries. It's cutting through everything from fintech to agri-tech. So it's not useful trying to talk about it on its own. This chart is a bit of a thermometer. It tells us where the really hot money has been and is probably going in 2026, where the hot money is, and then where I wouldn't call it lukewarm, but some of the growing areas, or tier 3, the emerging plays. So fintech, there's no surprise there. Climate, energy transition, and critical minerals. By deal number is probably the biggest, but by dollar number, it probably took somewhere in the order of 15% of the capital that was put into startup venture funding last year. And you can go and look up your own resources there. There's 3 or 4 out there. They're all excellent resources. I don't want to replicate them. I like looking at them, obviously. They're very informative. But if we form the view that every year, other than for 2021, which was the peak and coincided with that 15.9 times multiple that I spoke about on slide 1, 2021 was a massive year, and I think we raised 10 billion. But if you take that out, we're raising somewhere between 3 and 4 billion every year. So if I'm saying 25% went into fintech, you can probably work out that somewhere between, call it $800 to $1 billion that went into it. We've got the percentages down here, 15% into climate, 5% in each of life sciences, biotech, and medtech, which I actually think is a massive growth area. Robotics, automation, advanced manufacturing. We did have a little AI that snuck in there, but clearly it's part of that. Defense, space, and cyber security, and agtech and food and water security down here. These are the key areas that we're seeing come through pitchhawk and next level corporate. Payments, blockchain, tokenization, decentralized finance, digital asset infrastructure. What are the growth accelerants for 2025-26, and why I would still put this as number 1 is info sheet 225, which is ASIC's view on crypto and how it's going to look at all the different elements. Are they securities? Are they commodities? Are they managed investment schemes? What are they? And once we know that, we'll understand the regulatory aspects. We'll then understand how to actually create the products. And in America, we've got the Clarity Act and a couple of other things going on over there, which signals that the American government want to be a leader in this space. And they're making it, I guess probably the best way to explain that would be to say that regulation is the best antigen. And without regulation, we find that adoption curves slow down. But I think this one is going to get a major boost after 225 and what's going on in the US. Climate and energy, why is that still going to continue? There's a $1 billion strategic industries fund, the IAF, the green steel and iron focus, downstream minerals focus of the government. The feds have put $15 billion into the National Reconstruction Fund and the $4 billion critical minerals facility. We've also got CEFC and the North Australian infrastructure fund. So there's a ton of money being spent in this area. That ain't going away anytime soon. Life sciences, again, these are the key areas that we're seeing. They even had a CRISPR come through the doors, which I actually didn't think I'd see one, but that one's quite interesting. Anti-aging and Indigenous and rural health, and I think that's going to be massive. WA, what's going in? Cook government spending 1.8 billion. The Fed is spending 15 billion, obviously in the NRF, which we've covered. AI is a major accelerant, not just in drug discovery, but also for rural health. And I expect that to be tier 1 by next year. Plenty of activity out there. And I know with you too, Steve, what you're seeing a lot of biotech, medtech, health tech come through, which is unsurprising. 5% in robotics, automation, advanced manufacturing. We're seeing industrial robotics. It's probably the main area that I'm seeing. Mining, tech, METs, drones, green steel metallurgy, manufacturing, and some pure AI plays. The one that I really like is the Australasian Automation and Robotics Precinct up at Neerabutt. It's a super impressive facility. Government spent $28 million. I reckon it would cost you minimum $50 million now to try and bring something like that on. Expertly managed by the people at Space Cubed. Fantastic ecosystem that they're building up there. And the great thing about that, and also like the Queensland Resources facilities, it means that individual companies don't have to waste capital on either building their own facilities, which most of them can't, or going into rural and hazardous areas to deploy trial units. So I think that they are major accelerants, as is AI. Aerospace satellites, cyber, autonomous defence. There's a ton of that going on in Perth. The Feds, obviously, through the NRF, and also just the geopolitical situation and the building of sovereign capability are creating some pretty big tailwinds, fast tailwinds for that sector. And obviously, the Cook government spending on Made in WA and the IAF. Agtech and food, well, clearly, if there's one area that could really benefit from AI, improving nutrient efficiency, crop yields, minimising water, that's the sector. Again, on the right-hand side, a lot of money's being spent on it. And I think we're just going to see more of that. Russia, Ukraine, COVID really taught us that supply chains are important. It's not just critical minerals, it's also food. That probably wraps that little bit up, Steve. And we'll probably, because we're running out of time, want to move on to the where and when of where the money's coming from. Across the top here, shall I look at this screen? Pre-seed, seed, Series A, Series B, Series C and IPO. So this is when people are investing, and this is who's actually investing, being pretty careful not to mention any names because we don't want to appear to be favouring any particular parties or disfavouring any particular parties. There's a whole truckload of non-dilutive methods. A lot of the people on this call will know about these, and obviously, Steve, your business is an expert at R&D tax incentive. There's also funding. It's all non-dilutive, government grants, venture debt, EFA, which is the old EFIC, or the Export Finance and Insurance Corporation, and banks. Now, not all of these are purely non-dilutive. Government grants, generally you need 50-50. So if you don't have the cash flow, you're going to have to go out there and raise some money. And venture debt takes options or warrants. So there will be dilution at some point in time. Angels, there's around 40 networks in Australia. There's 5 currently in Western Australia. They can be individuals or syndicates. They're typically wholesale parties. They like early stage, MVP and POCs. They put small checks in, 20 to 50 grand, some smaller. And the Aussie Angels platform is probably the biggest accelerant for it. It's just this super user-friendly platform that is making it a lot easier to set up a syndicate. The blue ones, and I won't cover them individually, they're goals-based investors, so they will accept a lower return as long as they can achieve their goals. Social impact funds, their goals are to alleviate social well-being and environmental disadvantages. Strategic investors, their goals are to effectively hunt for bulk, hunt for sustainable competitive advantage, and find missing parts of their puzzles. It's very common in fintech, METs. You would have seen a lot of it, and there's some very notable companies out there who are strategic investors. They are not corporate VCs, but they're investing tactically. And just in METs alone, I've calculated about $7 billion that have been invested into Australian METs probably in the last 4 years. So there's, they're out there. Moving on to really where the big money's coming from, it's family offices and high net worths. Those two groups are also the biggest investors in early stage venture capital limited partnerships, venture capital companies, and private equity. So this group here really dominates the wallet. Family offices are in the high hundreds. They're patient. They're not typically IRR focused like a venture capital firm or a private equity firm might be. They're private firms that manage wealthy family money, and Preqin, which is part of BlackRock, have basically analysed it and feel that they probably make up 40% of the total private investment in Australia. I haven't audited that number, but basically from what I see where the money comes from, I suspect it's probably even a little bit higher than 40%. High net worths, there are thousands of them. They're self-managed. They're similar to families, but they're not structured within the family office structure. They value trust and exit plans. Family offices, I feel, are probably a little bit more patient, but high net worths will invest with them, but they can also lead transactions themselves. So you'll see a lot of floats where high net worth investors around town have basically cornerstoned them. Early stage venture capital limited partnerships, real big growth there. 135 of them are registered with the ATO. They're tax driven. And what that means is that when you invest, you get a 10% tax deduction. And if you sell within 10 years, or if the fund sells within 10 years, the proceeds are CGT free. They'll invest pre-seed to Series B, and there's a ton of family offices and high net worths in them. VCs, we all know about them. They're in the low hundreds from an institutional perspective, but there's a lot of individuals out there as well. Corporate VCs, 8 of the ASX 50 have got corporate VC arms, and there's literally hundreds of them offshore that invest in Australia. Sovereign is probably the final one. I wouldn't ordinarily put this on, but after Russia, Ukraine, and the Trump 2.0, what we're seeing is a lot of sovereign capability being built up in supply chains, but also in bringing manufacturing back to various countries, reshoring certain industries, and also friendshoring. The sovereign wealth of the 290 billion future fund, the MRFF, EFA, critical minerals facility, etc. They're piling money into things. They're even taking equity stakes in certain companies. These are sovereign funds around the world, particularly in the US. That probably covers that bit, Steve. And the next bit, I don't know if you wanted to...
Thanks, mate. That's fantastic. And, very good run through it as quick as we can, if you like, on some very deep topics, and a good sort of close there on the key players, or how you group the key players, and again, that coming back to that understanding for where your innovation is at, what sort of investors you should be seeking, and also in noting that obviously family offices, high net worth, make up a bulk of the money in different ways. We sort of know it, but to see it for real, that makes a lot of sense. So that's fantastic. Thank you so much. Again, like I said, we could ask a million questions, but I won't. What's exciting for me now, obviously, and for the audience and for others, is the last stuff is really interesting, like I said at the beginning, but how do we actually put that into action? How do we take Mike and, if you like, spread him around so that more people can get fund ready, raise funds, and those sorts of things. So what really is exciting, and what I'm really looking forward to, is to share Pitchhawk, and if you like, how that is as a product and a service, so that companies can get, support and assistance to raise, because everyone needs it at some stage, and it's a hard process. So super excited. I'm going to sit back again, because otherwise I'll keep asking too many questions. And I'm really looking forward to, if you like, giving us the introduction and the launch. If you like, we're very lucky as well, everybody. Pitchhawk, is in practice with and used, but we're hearing it for the first time publicly. So mate, take it away. Wow us. I'm excited.
Thanks, Stephen. Thanks for the opportunity to to launch it here. Everyone's got a different way of raising money, and the fundraising preparation process is an area that's really been underserved for many years, probably for decades, and it's because founders really aren't aware of how, the history behind fundraising preparation, where it came from. It came out of the debt markets, with very, very thick circulars that used to be obviously circularized around to raise debt. And it found its way into equity. Obviously, if you're going to float a company, you need to write a prospectus. But over the years, it got to a point where ASIC came to the conclusion that if you're a certain kind of investor, you don't need disclosure. We call them, a lot of people call them 708s. They're professional, sophisticated investors. And they don't need disclosure because they're assumed to have the relevant knowledge to make reasonable decisions when they're deciding where to put their money, in simple terms. And what that meant was that you could basically go out, shake someone's hand, sign a subscription form, and raise money in an unregulated securities. In other words, for private securities. And that's all well and good. But over the years, people decided that they should probably pad it out a little bit more. So instead of having a sit down and a chat, the infamous information memorandum made an appearance. Some of the information memorandums you see today are 80 to 100 pages long. No one reads them. And when you send them to particularly a family office, and yes, there are always exceptions, they don't read them either. And if they see an advisor brand on them, no matter how good or bad the advisor is, they'll delete them. So there's a little bit of a problem there. Why did I launch Pitchhawk, or why did I spin it out at Next Level Corporate? It's those thousands of hours that Steve was talking about, 70,000 hours in the capital markets. You start to learn a couple of rules of physics or financial physics, and they are that, particularly in this area, professional investors don't back technologies. They don't even back innovations. They'll only back an innovation if they can see true investment signal. That means it's got to be in a company. It's got to be commercial. It's got to be viable. It's got to be scalable. It's got to be repeatable. It can't just be a one-off. And it also needs to be resilient and appropriately priced. And we think about it, or at Pitchhawk, we think about it as a fortress strength business, something that's mighty, that's dominating, that's got all of those signals that we've just spoken about, without having to constantly rebuild it, which takes capital and causes dilution. So that's what we call fortress strength investment ready, or investor ready. In fact, let's go through that very, very quickly. What's investment ready? Investment ready is summary ready. You've got an IM, you've got a financial model with some 80% discount rate in it that no one believes, and you've got a pitch deck. That's investment ready. But investor ready is being fortress strength ready. You've got before you try and summarize it, you've got a real business there, or you're building towards one, and with the investor money, you hope to complete your construction of your fortress. But you can't present one unless you're actually really building one. And we go back to the typical fundraising preparation process, which often ignores the truth. It papers over gaps and addresses them up as though it's a fortress, but it's not. And when investors see it, particularly if you give them an 80-page document so they can see it in all of its all warts and all, they're going to pick through it. They're going to, okay, that's missing, no signal there, that's noise, that is a massive risk. So why do it? The idea is that you really need to build a fortress first. And I'm guilty of not turning off my mobile phone before we started this, so I've just done that. So how do we do that at Pitchhawk? How do we help you build your fortress? We have a few superpowers. The first one, and it's the heart of Pitchhawk, is a pre-flight. And that's a live pitch session where you come in, you see me, and you pitch to me. It's a simulated professional investor pitch. I'll do Q&A at the end of it, but during it, I'm going to use 30 years of my expertise that I've been able to package up into my engine. That's a diagnostic. And I'm going to diagnose dozens of investability criteria to work out if you're fortress strength investor ready. Then you're going to get a report within 24 hours, and that report's going to give you the results of a full diagnostic. It's going to give you a Pitchhawk readiness level between 1 and 4. 1 is a hell of a lot of work is required. 4 is a killer proposal, and 2 or 3 is somewhere in between. And on top of that, you're going to get fortification recommendations. In other words, here's where you went really well. Well, first of all, this is the investability criteria. This is why it's important. Here's how you did. You'll get an individual score. Here's where you did well. Here's where you fell down, and here's how to fix it. And that goes for all of the different criteria. After that, you can go away, fix the parts you can fix. To the extent that you need some additional guidance, we also offer fixed price precision packages, because once we've fully diagnosed your business, we know what's making it tick and possibly what's holding the capital back. We can obviously help in a very focused way. So you can take those between pre-flights. The idea is you come back for another one and then essentially up-level your PRL. So you go from a PRL 2 to a PRL 4, which is Fortress Strength Investor Ready. And the final thing is that if you do score a PRL 4, the highest one, and you represent a strong fit with a next level corporate ecosystem investor, Next Level Corporate will invite you into a one-on-one curated match. So it's not going out there and signing a mandate to go out and raise money from 20 or 30 different sources. It is a curated match with a specific client or investor that Next Level Corporate feels would be a perfect fit for your business. It won't interfere with any of your fundraising plans. You can use advisors, whoever you want. It's just an extra string to your bow. And the value proposition is, well, we'll get you ready. We'll get your Fortress Strength Investor ready for around 10% of the cost of the typical or conventional fundraising preparation methods, which don't really work, in my humble opinion. If we just have a quick look at how it works, I'm going to rifle through it real quick, starting from the left. You book, you onboard and you pay online. You attend your 60-minute instructor session if you're a first-time pitcher. If you're not, and if you've pitched before, then you can go straight to a pre-flight. You go to your pre-flight, you then get your diagnostic report with your readiness level after it and actionable fixes. That's all in written form. I've got an example of it on the next slide, so I can quickly show you that. And then you either fortify your weak areas yourself or you select a precision knowledge package, and I'll guide you through that. And then you fly as often as required. And just going back to fixing these gaps, these aren't 5-minute fixes. These could be, we need to pivot. We need to stop what we're doing and redesign something. Our commercial model might need tweaking because we're actually hitting the wrong customer. We should be hitting that customer. So we're solving the right problem and it's a killer solution, but we're hitting the wrong customer. There's far too much friction in that channel. Let's move the channel. If you move that, probably going to have to change your commercial model and a raft of other things. So these could take a little bit of time. Fly as often as required, up-level your PRL. Once you hit PRL 4, your Fortress Strength ready, you go out there and raise money. If you're good enough, you should be able to raise money on your own, but you can use advisors. And there's also the bonus invitation only curated investor matching that next level corporate can provide. Then the point is, every time you're moving from one point to another, each time you step into the capital markets, come back for a pressure test. I'm 100% independent. I'm not associated with any specific party. We act as a finishing school for accelerator cohorts. We act as referral sources, and how would I describe it? Where a professional investor sees a particular startup that they feel is really promising, but it's underbaked, we can act as a triage for that. So we are purely independent. We help the entire ecosystem, and we don't discriminate. So each time you go from seed to Series A, you then move to Series B, C, and E. You're looking to IPO or even sell, come for a pressure test. That's what the pre-flights are all about. Finally, the report that you're going to get is going to explain to you exactly what the fortress metaphor is. Every key investability and business element has got no surprises, a fortress analogy to it. So we'll go through that, we'll define them so you know exactly what you're looking at. All of the key investability criteria, this was a PRL2, it was the first one that came through. I didn't want to have to redact every single private mention, so I've just blurred it out. But all of these happen to be the investability criteria and our advice to this particular startup on their specific companies. All of these reports are tailored. And then basically right at the end of it, we'll provide you with some next steps. That's effectively pitchhawk. I would love to get this into a hashtag, but it's too long for a hashtag. But build your fortress before you try to summarize it. Let's just get rid of all of these IMs that no one reads. And in fact, if you've got holes in your business, you're telegraphing 50 or 80 pages to an investor of where all the holes are. So I don't know why you would be writing them. There are some occasions where you need to, definitely for debt funding, you need to write a prospectus for IPO. But for this, you want to walk into the investor's office. You want to be able to articulate that you've got a fortress strength, investor ready, call it shovel ready if you're in the mining industry, an investor ready business that they should be investing in today. So sit down and talk to them one-on-one. Tell them your origin story. Go through all of the investability criteria. I think you'll get another meeting after that. So before you try and summarize it, build your fortress. And with that shameless plug, that's probably it from me, Steve.
That's awesome, mate. You smashed it right on time and right on topic. That was fantastic. I'm super excited for you to be able to offer this, because I'm a massive believer in diagnostic approach to the innovation journey, and that each step of the innovation journey needs to be re-diagnosed. And that's exactly what you're doing. You're going, cool, you're here, and you're at this seed stage. Okay, we're going to give you a PRL. We're going to diagnose you, which doesn't mean that it's easy. It's still hard, and it still takes your 30 years to build the diagnostic package, if you like, that then you can apply to assess, to then go, okay, you're a 1, you're a 4, you're whatever you are. But then the project is ready, the innovation is ready to go, well, I should focus on this now. So even if, I truly believe, even if the company's not going to raise money, if you're going through your journey, people, and you go, what should I be focusing? Is my business scalable? Is it growable? Is it going to be good for future investors in 2 years' time? Well, you want a fortress, you want a diagnostic approach, you want to summarize it and figure it out. So even if you're not going to raise money, this is the sort of thing that can really help you focus and give you that, third party, true independent look at what you're doing to go, that's cool, but if you just swing it a bit this way, you can really nail it. So thanks, Mike. So
pleasure, Steve.
We're going to share. So what you Mike's also given us, and so this is another massive bonus to those of you here. Mike's had an ebook on basically what we've been talking about, pitchhawk and the markets and everything. So it's not a marketing document; it's a full-on ebook. So thank you for preparing that and being prepared to share that with everybody here today, mate. So send the ebook out. To get in touch with Mike, there'll be contact details, but simple, log in, book your session, get your first pre-flight booked and done. How do you know if this is going to work? Do it. and make it a part of your innovation process, your diagnostic, to figure out what you should be focusing on. So that's just about a wrap. Thank you so much. Thank you for all logging. Really appreciate, our time is the only resource that we can't get back. We can get more money. We can do this thing. We can't get that last hour back, but I don't want that last hour back because that was perfect. I've spent this hour in the best place I could have to learn some great stuff, and have an opportunity to share this with other people in the future is critical. Also, when we send the email out, as in the thank you email and the ebook and everything, we're always keen to get a survey from the attendees. Did you like it? What can we change? What else can we do? So, WA Innovation Calendar is here for the community, and so we want your input into hearing from Mike again and other things that you want to do. So let's wrap it up. Hashtag value bombs. There's your hashtag, mate. And there's another one I came up with recently. Hashtag truth hurts on tough love. And so if you get a PRL of 1 or 2 people, it's tough love that you need, or we need to hear that sometimes. So hashtag tough love from hashtag tough Mike. Thank you all.
We're also cuddly, and we're also friendly. So we're here, and we're ready to help.
I love it. Well done. It's a hawk, not an eagle. Good stuff, everybody. Have fun. Have a great weekend. Cheers, Mike. And see you all soon.